Now, we need to have a little chat about interest rates and potential concerns on the horizon with interest rates in 2024. Now, over the last 18 months, the RBA has increased the cash rate 13 times, and this is hurting people who have a mortgage. Now, the fact of the matter is, this is not everyone. Not everyone has a mortgage. If you look at Australia's debt profile, roughly about 25% of Australians have debt over the entire valuation of property, because there's a lot of people who own their home outright, or a lot of people who had a very small cost base 10 to 20 to 30 years ago for their property. It's actually the new investors and the new homeowners who are struggling with their cash flows as these rates significantly increase. Now, before we take a look at 2024, let's look where we've been in terms of the cash rate. As you can see on screen, cash rate got as low as 0.1% in around July 2020. And we had that entire COVID period of about 2 years of essentially no cash rate. And now we're seeing that big uptick now with the cash rate sitting at 4.35% in November 2023. Now, if you look back historically, a 4.35% cash rate is not unreasonable. All the way back to the 1990s, through the 2000s, up until the GFC in 2008, the cash rate sat around that 4.25 to 6% target, which means investors and owner-occupiers were paying on their own home loans or investment loans around about 6 to 8% in terms of their interest rates. So for about a 20-year period there, the cash rate sat between 4 to 6%. So when people say the cash rate is hurting them, it's just that they've not been aware that this is a very normalized cash rate based on past history. It's only recent history that we've seen such a low cash rate at almost nothing, which has put us in this current position. Now, the real question is, in 2024, are we going to see further rate rises? And so the RBA is putting out a warning, trying to dampen people's expectations around the economy and potentially open the door to allow them to make a few more interest rate rises. There have been a lot of talks of interest rate cuts in 2024, but if inflation continues to push up and people continue to use their cash reserves because there's billions of dollars sitting in offset accounts and billions of dollars sitting in cash in people's bank accounts, then that could continue to drive inflation. Now, we're also seeing migration, both overseas and interstate here into Southeast Queensland. And a lot of the other minor capital cities like Perth and Adelaide are also seeing those effects of migration from overseas and interstate. Now, again, most of the migrants will land in Sydney and Melbourne first and then move interstate to a Perth, Adelaide or Brisbane. So as I'm a Brisbane buyer's agent, of course, we focus on the Southeast Queensland market. And what we're seeing on the ground here is property is not slowing down. I did a 7 News interview at an auction in Kedron on the north side of Brisbane just last week. Now, they cut out my piece in that interview because they were talking about home loan mortgage stress. And what I'm seeing on the ground does not tie to what 7 News was actually reporting in their article or in that story for that day. The story that 7 was selling in that case was that mortgages and homeowners are struggling. We've had these 13 rate rises and people are swamped and people are going underwater because they bought too much home. Now, you do need to be careful when it comes to your cash flows. Emily and I have always focused on building our investments first, build the portfolio, build your investments, build your asset base, manage your cash flows, and have big buffers. Don't expect rates to sit at a low amount. Always at a 3 to 5% cash buffer on the current interest rate you're paying. So even in my portfolio, I look at our rates at the moment around that 6 to 7% mark. Emily and I stress test our portfolio on 10 to 12% interest rates in the worst case scenario. And as you may have seen in recent videos over the last few months, we have a property portfolio that generates over $200,000. So looking at the debt in our portfolio, you need to make sure that you can manage future interest rate rises. Now, I can't disagree with 7 News that there are absolutely people out there struggling, and we have an undersupply of property here in Australia. So going back to that auction that we had at Kedron on the north side, I was there for some clients who are owner-occupiers looking to invest and then eventually move into this property that they're looking to secure here in the Southeast Queensland market. Their budget sits somewhere between $900,000 and $1.25 million. So this property on the north side of Kedron, I expected the price to be around that $1.25 million. There are about 30 registered bidders there and about 60 groups on site. This auction went bananas. That's all I can say. And eventually sold for 1.38 million. And Domain even put an article out that the girl who won the auction, her husband was off fishing. So they managed to buy their own home or their future home while he was off fishing and while she was bidding at the auction. So all this to say is that there are some people who are struggling, but there are lots of people who have the financial capacity to build a property portfolio or buy their own home. So the important thing for you here is understanding where the RBA might go in terms of these cash rates to affect your interest rates going forward, and make sure you have the buffers in place. You are the controller of your financial journey. It's not up to me. It's not up to someone else. You're the one that's in control. And I do say this to all of my clients. It's your money at the end of the day. As a buyer's agent, I'm here to work on your behalf, educate you, show you the analysis, show you the research, have the negotiations on your behalf, and save you as much money as possible to buy the right property for the right price in the right location. But also yourself, you need to take responsibility. I personally take responsibility, and I know Emily does as well, for our good and our bad decisions as we build out our property portfolio. So let's take a look at what the RBA is saying in terms of 2024 and what the future might hold for interest rates. You can see here that signs point to 2024 RBA cash rate hike. One measure the RBA has used to gauge the market expectations for the path of the cash rate was the overnight index swaps, or OIS, a financial instrument used to determine interest rates. The rate has increased in recent months and particularly rose in response to the release of the minutes in the RBA's October board meeting. The RBA said the minutes were interpreted as being somewhat hawkish by the market following the higher than expected inflation data. Now, if inflation persists, the RBA has one blunt instrument, and that is the cash rate. The RBA can't go out and affect suppliers or affect property developers or affect migration. That's up to the government. But in this case, if the RBA sees persistent inflation and they're going towards that target band of 2 to 4%, then all the RBA can do is increase the cash rate. And this really hurts those owner-occupiers who have a large mortgage and have bought too much home, as well as investors who are looking to build out their property portfolio and manage their cash flows. Now, I myself as a chartered accountant always understand the cash flows. And when we sit down with our clients, we go through detailed numbers on the purchase price, looking at the assets, the liabilities, the equity, and then looking at the profit and loss. So what's the revenue generated by this property? What are the expenses generated by the home? And what's the net cash flow? Also looking at some depreciation benefits as a bonus, and also looking at your tax outcomes if you have some negative gearing. Now, given these current interest rates, a lot of investors are going to be moving into that negative gearing territory. So it's important to make sure that you can stomach that negative gearing, and also make sure you look to balance your portfolio between capital growth properties and cash flow assets. So it's important to find that balance and make sure you're not creating too much stress in your life, because at the end of the day, you're looking to build a portfolio to give you choices, not add a burden to your life. And a lot of investors get stuck at 1 or 2 investment properties, which is not going to change your life in retirement. In my opinion, you need between 3 to 5 homes to build out enough of an asset base to create choices and to create financial freedom. And that's going to sit for most Australians somewhere between $1.5 million to $3 million worth of investment property held over a longer period of time, as well as looking to use some other strategies like manufacturing value here and there, pulling out equity as you go along, and adding granny flats to boost the cash flow in your property portfolio. So let's read a little bit further about what the RBA is saying in terms of future interest rate rises and see what the solution might be for most Australians. So, this hawkish opinion is consistent with the views of market economists. Moreover, compared with a few months ago, market participants expect the cash rate to remain around its peak for longer. Now, this could mean that we don't have a rate cut in 2024 that everyone's been talking about. Everyone's been hoping and holding out for the next rate cut. But if we had a rate cut, people might run back into the market. The Australian property market is already undersupplied, and we're already increasing migrants coming in from overseas who are skilled workers. This story just leads to more pressure on property. Even though the rates have gone up, we've got increased demand with more people coming into the country. We've also got reduced supply because builders are not making enough property as quickly as Australia needs it. So in order for Australia to reduce pressure on property prices, we need 1, demand to decrease, so less people to want to go out and buy a property, and also 2, supply would need to increase. And this is in areas where people want to live. You can't go build out homes in the middle of Australia because Australians don't want to live there. Their jobs aren't there. So this needs to be in the cities, in Sydney and Melbourne. And there needs to be more density in some of those inner city locations to make up for these increasing population numbers. Now, one other big consideration with these interest rate rises that the RBA has made is how they're going to impact people moving forward. So the RBA board is mindful of painful budget squeeze. Earlier tightening in monetary policy is still working its way through the economy. Now, that's a really critical point, is that these 13 rate rises haven't come into full effect. A lot of Australians were on fixed interest loans, and these loans were somewhere between 1 to 4 years. And so we've still got people who are sitting on 2 to 3% interest rates, and not all of those fixed loans have rolled off onto these higher variable rates. I'm actually in that boat. Some of our investment loans will be rolling off a 2.79 up to a 6.4% interest rate. So you need to look at your own cash flows and manage your property portfolio accordingly. However, the Reserve Bank expects the number of borrowers still rolling off low fixed rates to ease in the second half of 2024. And that means they think the rates will have their full effect in the second half of 2024. The board's also mindful that many households are facing a painful squeeze on their budgets from both high inflation and higher mortgage rates to date. There are also economic and social benefits in preserving as much of the gains in the labour market as possible. Weighing all these considerations, the board judged that after holding policy rates steady for the past few months, it was appropriate to raise rates at the November meeting. So the real question is, will there be a rate rise in 2024? I think it's absolutely possible that this could happen. If people have all these excess cash reserves, they're in a strong position, and there are some Australians who are struggling, the government may continue to put pressure on the cash rate. Now, what I think is more likely to happen is that we'll stick at this cash rate for a longer period of time. The new governor of the RBA is not going to want to be an unpopular person, but will also probably make hard decisions if necessary. So I think what the RBA will look to do is sit on this higher cash rate, let all those fixed rate loans roll off, and then see what happens in Australia's economy. I think they're going to keep the cash rate higher until we start seeing that persistent inflation decreasing over a longer period of time. And I think that might be another 12 months. But what does this mean for property prices? Given that supply and demand equation we've been talking about, I don't see property prices decreasing anytime soon. If Australians understand their cash flow, they look at their income, they look at their expenses, they look at their investments and their own home, and they can stomach the risk profile of making an investment purchase, because looking at the supply and demand story, there's going to be more demand for property and there's no supply coming on the market anytime soon. It gives those people who are in the position and have the risk profile to go out there and take action and build their asset base off the back of this. Now, when we're looking at property investment, we're not taking a 12-month horizon. We shouldn't be looking at whether the cash rate's going to go up another 0.5 or another 1% in the next 12 months. We should be more worried about the bigger picture, also managing those day-to-day cash flows, but more worried about that longer-term journey. Now, in my business at Purpose Property, we also help people with renovations to manufacture value. We discuss the detailed numbers, the assets, the liabilities, the profit and loss for making a property purchase, whether it's your own home or whether it's an investment. Now, given my background as a chartered accountant, Emily and I break down our numbers in detail, and we do that with clients as well. So I think that's the most important takeaway from today. Yes, there's macroeconomics out there that might have some impact on your life. If the RBA keeps the cash rate higher, it may hurt you if you've got a lot of loans. It may make it more difficult. It may make it more difficult for you to manage your own home repayments or manage your investment property portfolio. But also make sure you take a step back, look at the bigger picture, and look at what you're trying to achieve. And if you can manage the cash flows and you can build your asset base, from what I can see based on the supply and demand, Australia's in a very good position to continue its strong growth run in property prices. I don't think we're going to have another property boom in the next 12 months, given where the cash rate's at. I know some other commentators are saying there might be a massive boom. But for me, again, I'm looking at that longer-term vision. I'm very bullish on the Brisbane market, obviously being a Brisbane buyer's agent and the greater Brisbane area. So if you want to have a chat with myself, head over to purposeproperty.com.au to book in a free strategy session. We'll sit down, talk about your short, your long-term goals, whether you're an owner, occupier, or an investor, and how we can help you secure your next purchase here in the greater Brisbane market. So I'd love to hear your thoughts down in the comments below. What do you think is going to happen with interest rates in 2024? Drop a like on this video, subscribe to the channel, and click this video over here for more things real estate, renovating, and financial freedom. I'll see you in the next one. Peace.